I'm joined with Gwen Preston here at the Red Cloud Fall Mining Showcase from West Red Lake Gold Mines. Gwen, thanks for joining us.
Thank you for having me.
So we were just talking pre-interview and I said, let's get the cameras rolling because I had an interesting question to ask you because you're a former letter writer covering the junior markets. And one of the things that I think about a lot is for us as a media company where we're constantly chatting with CEOs in the mining space is it seems like the hardest way to possibly learn about geology and mining because everybody's incentivized to try to tell you that what they're doing is the best, and no matter what the actual objective analysis of the situation may be, you're getting these really biased lenses from everybody. How did you navigate that as a letter writer?
I mean, that's really a good thing to point out, because yes, geology, mining, they're incredibly complicated. And yeah, whenever you're talking to a company, you are by definition going to get, like you say, a biased lens. As you were asking the question, those were exactly the words that I had in my head. So I navigated that in one way which happened to me that was lucky, which is that I started my career as a journalist. So I started my career not investing in the space, but just being paid to learn about it. So I wrote for the Northern Miner for 5 years, and that gave me the opportunity to travel the world and ask questions until I understood. And so because I wasn't actually even considering investing, I wasn't allowed to invest in those companies, I wasn't burdened with that. I didn't have to know whether it was good or bad. I just had to figure out what was. So that was a really good way for me. Sure, I'm still getting a biased lens in those pitches, but at least I think that lens was a little bit less cloudy because of the position that I was in. And then the other thing is, in that time frame, I developed a really big network. And important in that network is a lot of geologist friends. So now, after that, whenever I encountered a project, and I'm not a geologist, and I had porphyry geologist friends, I had mesothermal gold deposit friends, I had VMS friends, I would send it. I'd be like, okay, tell me, this is what I see in here, pros, cons, what's your take on it? And so that was my way of being able to understand geology, not only hearing it from the company. Because yeah, it's a quagmire for sure.
Okay, so then you walk away from your business as a letter writer, you decide to get on the issuer side, you're now working with West Red Lake Gold Mines, which means sort of two ways of looking at it. One, you have to love the project. Two, you have to love gold. So let's start off with talking about gold.
Sure.
We're hitting all-time highs as we sit here. We're at a mining conference, and I think this is a good conference. I think that there's lots of good companies here, lots of good people here, but I'm a little disappointed by just the overall level of foot traffic, and I felt that way at other conferences too. It feels like for gold to be hitting all-time highs, there should be a lot more euphoria out there. I've used this analogy in a couple interviews before, but I was actually at this exact location 4 years ago when a cannabis company called the Green Organic Dutchman gave a corporate presentation that had 2,000 retail investors show up to watch that. And here, gold's hitting all-time highs. We're just not seeing that euphoria. So what's going on, and when is it going to hit our equities, Gwen?
Oh, my crystal ball. No, I mean, so I think what's going on is that Western investors are only just starting to pay attention to gold. And Western investors are the ones who buy gold equities. But the reason that gold is at an all-time high, just as the group of people who usually drive it higher are starting to get interested, is because of China and India, but mostly China. So we obviously just went through this intensive rate hike cycle from 2021, 2022, and classically a rate hike cycle of that nature should have hammered gold. And yet gold was unbelievably resilient through that phase. It rose as interest rates went way higher. Why did that happen? Because of two things that were happening in China. I mean, the Chinese massive growth phase ended, and the places that people had been able to put their money for 20 years, real estate, the stock market, and interest rates, interest-bearing entities, those stopped working. So then the Chinese investor, Chinese money, had to find a new place for security and upside. And they not surprisingly, found that in gold. I mean, the Chinese have always loved gold, but they usually buy it when it's weak. They do not usually, historically, they have not bought it on the ascent. But they started buying it on the ascent because they were in the midst of a paradigm shift within their economy, within their ability to maximize returns on their capital. So that was the retail or individual side. You can see the explosion of gold trading on the Shanghai Exchange. It was crazy. At the same time, of course, the Chinese central bank, first quietly and then publicly, started buying gold hand over fist. And that was a coincidence. What I mean there is that these concepts of deglobalization and de-dollarization had been very nebulous concepts for a long time, but then they became very real. COVID, Ukraine, the time is right in terms of bilateral strength of China and Russia. The time was just right for those things to become realities instead of concepts. And so now we're seeing China really actively shifting from treasuries and dollars into gold. Those forces are what kept gold strong when Western investors were not incentivized to look at gold because interest rates were going through the roof, and were doing really well just owning Nvidia or Microsoft or whatever it is that they owned in the S&P index. Now we're at a different moment. Now we're at a moment where we're in a rate cut cycle, and Western investors are therefore getting their classic cues to say, oh, it's time to look at gold. There's lots of other reasons for uncertainty that Western investors are starting to look at gold, but gold's already at all-time highs. That's a really interesting setup. Unfortunately for equities, looking back, that's why we have this gap. That's why equities, that's why the stocks haven't gotten advantage, haven't benefited from gold's move in the last few years, even in the last few months. Is that going to resolve in the next little while? I mean, I think that there's a good chance. People are still doing pretty well owning Nvidia. If those cracks start to form, if more uncertainty creeps into the picture, then I think we start to get the next level of cue for Western investors to move into gold, and it's Western investors who buy stocks. All those Chinese forces that propelled gold higher, they don't buy gold stocks. So I think that those forces are starting to compile. I think that there's therefore a reason to believe that this disconnect is going to resolve. It clearly hasn't yet, because like you say, we're sitting here and especially the juniors haven't had much love yet from this record level of gold.
Okay, so now I got to ask you about West Red Lake Mines. Why do you love the project? Why did you just choose to walk away from your letter writing business and go and work for this company?
So in my years of investing in gold, I love a good exploration story for sure. I mean, I love a good producer. But when I looked back, I realized quite clearly that the biggest returns and the most reliable category of company that generated returns, that came from companies putting new mines into production. That re-rate, it's got a lot of monikers that go with it, the golden runway, the second half of the Lassonde curve, the pre-production sweet spot. That's when you go from deciding to build a mine through to actually pouring gold or copper, whatever it is, but go to making money, go from spending to making money. That reliably, in fact, Scotia just put out a report today reinforcing this exact thesis. They looked at the last 17 companies that went from construction decision to first pour, and guess what? Sort of 30% average return in that time frame. That's and that's over a time frame where gold has not been very exciting. So I loved that. I mean, I want returns, but I also love it if they're not so fraught with risk as exploration always is. I wouldn't have shut down my business to join an explorer, but I am going to shut down my business to join a company that has a really deeply experienced mine building team and good access to capital because of the network that we're connected to, who's pursuing aggressive growth, because that's the concept of West Red Lake, is to ride that re-rate several times. Madsen's our first mine. We plan to put that into production through 2025. And then we are also actively looking for the next acquisition so that we can give our investors the next re-rate. So that's the thesis that drove me over to West Red Lake.
Okay, and my understanding too, we've got the sort of asset that was previously in production that was owned by, was it Pure Gold? Pure Gold, and they just, I guess what I was told by some of the people who were involved with the company, that they just kind of at first attacked the low grade, and they should have gone after the high grade, and that's now obviously that they had huge debt problems that ultimately took them under. This version of West Red Lake comes in. I forget what the assets were bought for. What was the mill bought for, like $6 million or something?
The whole project was bought for $6 million. Yeah.
And now we got all-time highs in gold. What is it that you guys can do differently to make it economic?
I mean, that is the fundamental question. I mean, that's the elephant in the room for West Red Lake for sure, and I like to sort of embrace that elephant because that's why we bought the asset. We bought the asset because we looked into what had happened under the prior operator, under Pure Gold, and we decided that the errors that had led them to fail in a short period of commercial operations, those were fixable things. The first fix is intensive definition drilling. They defined a great resource, but you can't mine Red Lake gold on a resource that's defined on 20-meter drill spacing. You just don't know accurately enough where the gold is. Red Lake gold is very high grade, but it's very inconsistent, right? You've got the lenses. So they defined the envelope that the gold exists in, but we are hammering that envelope with drill holes so that we have 6-meter spacing rather than 20, so that we can know exactly where the gold is. Their lack of definition drilling, combined with some issues in how they mined it, meant that they delivered material to the mill that was 3.5 grams rather than 8.5 grams. So it wasn't that they went after the low grade, it's that they ended up delivering low grade because of a failure to understand accurately where the gold was. So they diluted their mineralization excessively. So definition drilling is the mitigation for that risk in underground mining. We've already done almost 40,000 meters of definition drilling into our resource. Proactive mine planning so that you know you have good optionality and defined engineered stopes for sort of 18 months of operation, always rolling ahead of you, really fundamental. Pure Gold also, like you say, struggled with debt and costs. And there was a whole bunch of things, we could talk for ages about it, but if I distill it down a bit, several capital projects that would have made for a more efficient mine, they didn't have the capital to do, so that increased their costs because there were inefficiencies in how the mine operated and how the money flowed. And then COVID also hit them. Let's give credit to that. COVID, cost inflation, access to parts, access to labor, that really hurt. So that really hurt them. So their grade was way lower, their costs were way higher, and that's not going to work on any balance sheet. But we saw those as issues that we could remedy, and that's the work we've been doing for the last year. We continue to do that work, and our goal is to turn this mine on next year, and we believe we will have addressed those things when we do that.
The goal is to turn the mine on this year. So what does that ramp up look like? What kind of production should we expect out of the company, say 3-4 years when you guys are fully ramped up?
Absolutely. So we are doing everything at the same time. Usually a project goes through, a sequential order of resource and then PEA and then this, and then we're doing everything at the same time. We bought a mine that was already mostly built and permitted, and we've been doing all this definition drilling. We haven't accessed the last piece of capital yet, but we're going to start mining soon. We haven't actually issued our mine plan yet. So in only a few weeks, we will issue a pre-feasibility study that'll be largely feasibility level because we've already been active underground for the last year. The mill ran only 2 years ago, so all the costs are real. All the decisions are already made because it's built. So we are going to issue a pre-feasibility study that is our mine plan in just a few weeks. That will lay out the numbers for the operation. Our mill is an 800 ton per day mill. You know our resource grade. Based on those and past looks at the operation, it's reasonable to think that this will be a 60 to 65,000 ounce per year producer, and we want to ramp up to that through 2025.
Well, Gwen, thanks very much for hopping on here. I enjoyed chatting with you, and hopefully we can chat in the future as these results start to come in.
Absolutely. Thanks so much for having me.